Financial Reporting and Analysis. In this reading, we will talk about the objective of financial reporting. We will then discuss the distinction between standard setting bodies and regulatory authorities. In section 4, we will talk about the International Financial Reporting Standards Framework, or IFRS. Here we will also discuss the general requirements for financial statements. In section 5, we will compare IFRS with alternate reporting systems such as US GAAP. And then in section 6, we will discuss the importance of monitoring developments in financial reporting standards. First, a few introductory remarks. Financial reporting standards provide principles for preparing financial reports and determine the types and amounts of information that must be provided. So essentially, when accountants create financial reports, they create those reports based on published financial reporting standards. And this way, when financial analysts are studying the financial reports, they know what standards the reports are based on. There are several financial reporting standards, but the two major ones are IFRS and US GAAP. Most of the world uses IFRS, but in the United States, US GAAP is used. The differences between IFRS and US GAAP used to be significant, but over time, these differences are becoming fewer and fewer. This reading focuses on the context within which these standards are created. The objective of financial reporting is to provide financial information that is useful to users in making decisions about providing resources to the reporting entity. Now, we as financial analysts are classical users of financial reports. A given company, which is the reporting entity, will publish financial reports, and we will study those financial reports before deciding whether to provide any capital to the company. If we are equity analysts, we will be determining whether equity capital should be provided. If we are bond analysts or fixed income analysts, we will study the reports to determine whether we should be lending money to this company. The other aspect of financial reporting is to influence management's actions that affect or influence the use of the entity's economic resources. In preparing financial reports, companies must meet or follow financial reporting standards. These financial reporting standards facilitate comparison across companies and over time for a particular company. When we compare different companies, that is called cross-sectional analysis. And when we look at the performance of a given company over time, that is called time series analysis. Accounting standards must be flexible enough to recognize that differences exist in the underlying economics between businesses. So, for example, the banking business is very different from the manufacturing business, and accounting standards must have the flexibility to be able to accommodate these differences. Consider two companies that buy similar equipment for long-term use. One company expenses and the other capitalizes. What is the challenge that this might create, and how do financial reporting standards address such challenges? If you are a financial analyst, you are comparing these two companies. From an economic perspective, they are both doing a similar transaction. So they are both buying equipment, and let's say that this equipment is very similar, but company A expenses. And what this means is the company shows the entire cost. Let's say the cost is 2 million. So the company shows the entire cost in the income statement. So in the year where this equipment is purchased, the income is going to be very low because the entire hit is taken when the purchase happens. But company B capitalizes. What that means is company B creates an asset, and then depreciates this asset over, say, 10 years. What you can see from this very simple example is that even though the two companies are performing the same transaction from an economic perspective, but by treating them differently from an accounting perspective, they will end up with very different financial reports. And the life of an analyst then becomes complicated, because even with this simple scenario, he will have to identify the differences and then be able to make adjustments before he compares the financial reports. When companies are performing similar economic transactions, those transactions should be reported in a similar or comparable manner. Now let's look at the other element, which is flexibility. Say one company will make extensive use of the equipment while the other will not. How do financial reporting standards allow for such a difference? I already mentioned that company B plans to use the equipment over 10 years. Let's say company A will use the same equipment much more rigorously, and the useful life of the equipment over here with company A is only 3 years. Ideally, financial reporting standards should give both companies the flexibility to deal with their economic situation. And if you think about it, financial reporting standards do allow companies to define the economic life or the depreciation life here of the equipment. Company A could define a depreciation life of 3 years and depreciate over the 3-year period, whereas company B could define a 10-year life and depreciate over 10 years. So notice that accounting standards do provide flexibility. Standard setting bodies and regulatory authorities. Standard setting bodies are private sector self-regulated organizations. They have board members who are typically experienced accountants, auditors, analysts, and academics. The two major standard setting bodies in the world are FASB, which is in the United States, Financial Accounting Standards Board, and IASB, which is the International Accounting Standards Board. They set standards but do not have the authority to enforce the standards. Regulatory authorities are government entities. They are country specific. SEC is the regulatory authority in the United States. FSA is the regulatory authority in the UK. They have the authority to enforce financial reporting requirements. So note that since they are a regulatory authority, they are operating within the jurisdiction of a given country, so they can enforce requirements. They can overrule private sector standard setting bodies and establish standards in their jurisdiction. So if you have a given country like Germany, even though Germany follows IFRS, which is published by IASB, but the regulatory authority in Germany can make minor adjustments to the reporting standards for their own country. The regulatory authorities regulate capital markets in general. So the point here is, while they enforce financial reporting standards, they often have a larger mandate, which includes the regulation of capital markets. International Organization of Securities Commissions, or IOSCO. IOSCO is not a regulatory authority, but the members, such as the SEC, regulate a significant portion of the world's financial markets. This organization has established objectives and principles to guide securities and capital market regulation. So you can think of IOSCO as an umbrella organization. Simplistically, you can think of it as a United Nations of the regulatory organizations. So the core objectives that are published or that are promoted by IOSCO are to protect investors, ensure fairness, efficiency, and transparency, reduce systematic risk. In other words, rather than every individual regulatory authority coming up with best practices, what these regulatory authorities have done is formed this overall organization called IOSCO, which publishes the best practices in the form of objectives and principles, which can then be adopted by each regulatory authority. The major principles are the following. There should be full, accurate, and timely disclosure of financial results and risk. Financial statements should be of a high and internationally acceptable quality. Let us look at a simple example. Which of the following is least likely to be required by the SEC for a company which is filing for registration? Note that you need to learn the material from the previous slide very well. Clearly, the SEC, which is a regulatory authority, will require audited financial statements. As noted on the previous slide, an assessment of risks is also going to be required. Since the question is least likely, the correct answer is C, or projected future cash flows. These are very subjective, and while an analyst needs to come up with projected future cash flows to assess whether or not to buy a particular security or whether or not to buy a bond issued by a company, but from a regulatory perspective, it is not necessary that companies share their future projected cash flows.